Okay, want to hit a couple little tidbits of information to elaborate and elucidate from as a follow-up to some of the information we were doing on Tuesday and Thursday last week, particularly when it comes to the foreign tax credit, which is labeled sort of like this in a combination of script and print writing. Foreign tax credit, as we learned, is first a deduction, and you can elect to take the credit, a dollar for dollar offset against tax. In the literature of the foreign tax credit, you're going to find a topic called the indirect credit, and that's what I want to talk about first, the indirect credit. And the concept of the indirect credit is that it's not direct, but it's not just that. It comes about in a slightly different way. It's somewhat related to the branched profits tax. When we did inbound taxation, we talked about the branch profits tax, trying to make sure that foreign corporations coming into the United States wouldn't repatriate their earnings and bypass the dividends tax that we have here for U.S. source income made by foreign corporations. Here, the indirect tax credit, foreign tax credit, is in a sense the opposite way, an outbound matter. And here's how it works basically. So you have a U.S. corporation, and what they'll do is they'll own a foreign corporation, FC Corp, foreign corporation, to double up the language. And what happens is that the foreign corporation will pay a tax on its earnings, so it will have a foreign tax on what it earns. And then at some point in time, they'll want to repatriate those earnings back to the U.S. And when they do so, they'll be subject to, of course, a dividend tax at that point. The reason why this is called an indirect tax is because it could be, and very often it will be, that at the time that the dividend is paid, this dividend, it may be in a country with either a low tax rate to begin with on dividends paid out of its country. It could be zero tax for dividends paid out of the foreign countries, foreign corporations that exist there. It could be a low tax bracket just because of the tax treaty between the foreign country and the U.S. So again, when the foreign corporation, FC Corp, pays the dividend, there may actually not even be a tax on that when it happens under the foreign country's tax rules. So you have a choice of, it could be just zero, could be a low percentage, or it could be low because of the tax treaty itself, any number of reasons, and there might not be any tax at the time the dividend's paid. Yet, at the time the dividend's paid, that's when the U.S. tax hits in, and that's when you would expect to be able to match it against the foreign tax credit. Well, as you can see, there's little or no foreign tax paid when the dividend's paid. Yet, when the earnings occurred in FC Corporation, when it earned the money, one can expect that an income tax on those earnings may have occurred in that year, and therefore a foreign tax would have been paid. Yet, with no income coming to the United States that year, there wouldn't have been any foreign tax credit with which to take against anything. The foreign tax itself would have stayed down here at the foreign corporation itself. So let's do this again in another way. Let's see if we can illustrate it one more way. Let's go year one. Foreign corporation, FC, earns $100 and pays, let's say, $40 of tax in the foreign country, leaving $60 of earnings and profits to accumulate in the foreign company. Interestingly enough, year 2 comes along, and in year 2 the FC Corporation pays no dividend, continues to hold the $60 in reserve, thinking that it might use it for some other project. Year 3, the management decides that FC no longer needs to hold the E&P, so the E&P is now paid as a dividend in year 3 to parent company, which is a U.S. corporation. Yeah, USA. All right. That's how it looks. This is how it looks from the foreign company side of the fence. Now let's go see what it looks like on the U.S. side. And to do that, we'll get a fresh piece of paper. So on the U.S. side, it's year 1, and assuming it's not a controlled foreign corporation, no income is recognized because no dividends paid, no foreign tax credit. So that would be the income from the foreign corporation, and thus foreign tax credit is 0. Year 2, and the reason for that is even though foreign corporation we saw made money in year 1, it didn't pay a dividend back to the parent company. In year 2, the same thing is true. Nothing happened, no dividends paid from the foreign corporation to the USA parent. Remember, we're looking at the USA parent right now. And year 3 comes along, and as we saw on the prior page, in year 3 a dividend is paid, so suddenly a $60 dividend comes in, and there's no foreign tax against it, so there's no foreign tax credit, or at least it appears that there's no foreign tax credit. But back here in year 1, foreign tax was paid on the earnings, which are now being paid out in the form of a dividend in year 3. It's a timing matter. It's a timing matter. Had the dividends been paid out here in year 1, the $60, we could have matched it against the income paid by the foreign corporation for a foreign tax credit, and all would have been well. But that's not what happened. So here in year 3, what we do is we allow for, and you can read about the mechanics of it, but we basically are allowing for the foreign tax credit to be applied to year 3 based on the tax paid back in year 1. And that way it avoids double taxation. It avoids double taxation. That's the concept. You may think of this even better if you think back to the dividends received deduction of C Corps. C Corps in the United States, they own other C Corps that are U.S. corporations, and these are double taxed entities, so they're 2x, meaning 2 times taxed. And in order to avoid it compounding when C Corporation pays a dividend to its parent here, we allow C Corp parent, this is the parent company, this is the subsidiary, so we allow the parent company to take a dividends received deduction. Look it up in your original first and second account, tax books that you had for tax 1 and 2. The dividends received deduction avoids extra taxation levels, and that makes sense that the law does that. So that's really what's going on over here, is that we're allowing the tax paid back in year 1 to be utilized here in year 3. So it's considered an indirect foreign tax credit because the tax didn't occur this year. It wasn't direct this year. And that's why it's called an indirect. And that's basically, there are a whole lot more rules to this and a whole lot more innuendos, which you should be reading about in your textbook. And it'll be on the, I think it's on the notes handouts from the class. We didn't go in detail, but you should be able to read through those and get an idea what that's about. All right, so we'll hold here, and I have one other topic I'm going to bring up in a subsequent video.